If you stood by the iconic Inoden railway crossing in Kamakura this past January, you'd notice something unsettling. Usually this spot is a chaotic sea of slam dunk fans, mostly from the Chinese mainland, all jostling for the perfect photo. But this year the air was strangely thin. The crowds have vanished, plunging by over 60% in a single month. At first glance, you might dismiss it as a calendar quirk, a shift in the Lunar New Year dates. But as you walk through the luxury boutiques of Ginza, where the explosive buying once defined the retail landscape, a much grimmer reality sets in. The Japanese yen, once a symbol of global economic dominance, has quietly withered. It has shriveled to just 1/3 of the strength it held during its 1995 peak, hitting its lowest point since the world moved to floating exchange rates in 1973. For the average person, it's like trying to run a marathon while the oxygen is slowly being sucked out of the room. But then the narrative gets even more complicated. In the halls of the Diet, Prime Minister Sanai Takaichi is projecting a fiercely different image. Fresh off a historic election victory, she stands at the podium, her voice steady as she calls for a strong Japan. She mentions investment 24 times in a single speech, promising a future built on AI, semiconductors, and a responsible yet aggressive fiscal policy. She talks about strategic reciprocity with China, even as Beijing tightens the screws on rare earth exports, sending the prices of essential materials like yttrium doubling in a matter of days. It is a jarring contradiction. A leadership promising a high-tech renaissance, while the nation's fundamental purchasing power is in a freefall. Takaichi preaches stability and growth, yet the small businesses are bracing for a wave of interest rate hikes they might not survive. And the domestic factories she hopes to revive are hesitant to return to a land where the currency keeps losing its bite. Is Takaichi's strong Japan a visionary blueprint for survival in an era of deglobalization? Or is it a defiant final stand against an economic tide that has been receding for 30 years? As the price of the future skyrockets and the yen continues its historic slide, we have to ask, what does national strength actually look like when you can no longer afford to buy the world?
It's a phenomenal question. And frankly, it's really the only question that matters in Tokyo right now. You have this incredible tension between the political rhetoric of strength, the projection of power, and the economic reality of, well, extreme vulnerability. The contrast is not just sharp, it's dangerous.
That is exactly what we're going to unpack today in this deep dive. We've got a massive stack of documents to go through. There's fiscal analysis from Allianz, some really concerning discovery alerts regarding supply chains, reports from the Ministry of Defense on economic security, and some on-the-ground tourism data that paints a pretty stark picture.
Yeah, the data is definitely pointing to a massive shift.
Right. So the mission for this deep dive is to explore the high-stakes gamble of Japan's 2026 economic and security pivot. It really feels like the country is trying to do two opposite things at once. You know, they want to engage with the world to sell this high-tech future, but also build a fortress around themselves to survive the geopolitical storm.
It's this clash between the desperate need for national security independence, actually standing on your own 2 feet, and the undeniable economic reality that Japan is deeply interdependent with its neighbors, specifically China. You just can't flip a switch and undo 30 years of integration without breaking a lot of things in the process.
I was looking at how Japan's current economic policy, encompassing monetary normalization and strategic industrial investments, aims to counteract long-term stagnation and demographic decline, and its potential to reshape global capital flows and regional economic competitiveness. It just feels like they're trying to reverse gravity here.
Reverse gravity is actually the perfect metaphor. They're fighting forces that have been pulling them down for decades. To really understand why this is such a massive gamble, we have to look at the political mandate first. Prime Minister Sanai Takaichi just won a historic election in February 2026.
Right. That was a snap election on February 8th. She dissolved the lower house specifically to test the waters, didn't she?
She did. She used her personal popularity, which is unusually high for a modern Japanese premier, to secure what is essentially a license to spend. She's leading a coalition between the LDP and the Japan Innovation Party Ishin.
And that partnership is pretty key, isn't it?
Absolutely. Because Ishin pushes for reform, but Takaichi is pushing for what she calls active fiscal policy. The platform is incredibly aggressive. She's calling it responsible and proactive, which is really just politician speak for highly expensive.
Yeah, proactive is doing a lot of heavy lifting in that sentence.
Yeah.
I'm looking at the campaign promises right now. She's talking about suspending the food tax to help regular households, but simultaneously ramping up defense spending to 3% of GDP by 2030. For context, the traditional ceiling was 1%, and we are currently sitting around 1.4%. That is a doubling of military output in just 4 years.
And the markets are reacting to this immediately. They're calling it the Takechi trade. Investors see a government that is completely willing to blow out the budget to secure the country's future. And it's a big one. You have to pay for it eventually. And the spending spree is happening at the exact moment the Bank of Japan is trying to do the hardest thing in central banking,
which is normalizing monetary policy after decades of free money. The end of Zero Land.
The end of Zero Land. For decades, Japan was just this anomaly. Zero interest rates, zero yield on bonds, zero borrowing costs. It was a strange economic stasis, almost like being in a coma. But that era is dead now. And critically, the widowmaker triad is dead.
I see that term in the financial notes a lot, the widowmaker.
Yeah.
Can you explain that for you listening who might not be trading bonds every day? Why give it such a grim name?
It is a grim name for a really grim trade. Basically, for about 20 years, global hedge funds would look at Japan's debt and say, okay, this is unsustainable, yields have to rise, bond prices have to fall. So they would short Japanese government bonds, or JGBs. They were constantly betting the rates would go up.
But they didn't.
Right, because the Bank of Japan, the BOJ, had infinite firepower. They would just print money and buy the bonds to crush the yields back down to zero. The hedge funds would lose everything time and time again, hence the widowmaker.
Wow. But looking at the charts we have here, the yields are actually moving now.
That's the monumental shift. The trade is not a guaranteed loss anymore. The BOJ is finally stepping back. The widowmaker has essentially retired.
We actually have the text of a speech from BOJ Governor Kazuki Masu from February 2026. He sounds surprisingly optimistic about this whole thing. He says Japan has fully transitioned into inflation and that the consumer price index is consistently above 2%.
That is the ultimate signal. He's talking about a virtuous cycle. You have to remember, for 30 years, Japan had a deeply entrenched deflationary mindset. Companies hoarded cash, people didn't spend because they knew things would just be cheaper tomorrow. Masu is saying that psychology is finally broken. He points directly to the 2026 Shuntut, the spring wage negotiations.
Right. The major union confederation, Rengo, is demanding over 5% wage increases.
Exactly. And 5% is a number we haven't seen in Japan since the bubble era. It suggests that the labor market is actually tight. Masu is saying that negative interest rates are definitively over. They are testing neutral interest rates now. He wants the economy to stand on its own without the constant crutch of cheap money.
But here is where it gets really interesting and, frankly, a little terrifying. You have the prime minister stepping on the gas with spending, defense, AI, tax cuts, and you have the central bank stepping on the brakes with interest rates to stop inflation. That sounds like a recipe for a massive car crash.
It's the classic macroeconomic conflict, fiscal expansion colliding with monetary tightening. And the Allianz report we have highlights exactly where the danger zone is. They call it the debt precipice.
The numbers in that Allianz report made my eyes water. They are projecting a potential debt-to-GDP ratio hitting 228% by 2050 under the current plans.
And that's the optimistic scenario. If yields remain high, or if the fiscal policy gets even more expansive, which Takaichi seems to really want, it could go even higher, maybe 254%. Japan already has the highest debt load in the industrialized world.
The market definitely seems nervous. The JGB yield curve shifted up 20 to 30 basis points in a single session after the election. That's a massive move for a market that usually moves in fractions of an inch.
And this is where you really need to pay close attention, even if you don't live anywhere near Japan, because Japan is a major external creditor. Japanese banks and pension funds own a massive amount of global assets, specifically U.S. treasuries.
This is the contagion risk they're warning about.
Think about the basic logic here. If you're a Japanese pension fund manager and for 20 years, Japanese bonds paid you 0%, you had to take your money to America to buy U.S. treasuries paying 3% or 4% just to get a return. But now, if Japanese yields rise, if you can get 1.5% or 2% at home in yen without dealing with any currency risk,
you bring the money home, you dump the foreign assets.
Allianz calls this the liquidity channel. If Japanese banks start selling off U.S. treasuries to buy JGBs, it drains liquidity straight out of the global system.
And if they sell a ton of U.S. treasuries, the price of those treasuries falls, which means the yield on U.S. debt inherently goes up.
Correct. And Allianz warns that if U.S. Treasury yields hit 5% because of a massive Japanese sell-off, that is a breaking point for the U.S. economy. Mortgage rates in the U.S. go up, auto loans go up, corporate borrowing costs skyrocket. It could trigger a massive sell-off in U.S. equities. So your 401k in Ohio or your pension in Manchester is actually directly tied to whether Prime Minister Takaichi can balance her budget in Tokyo.
That is a wildly sobering connection. It's the butterfly effect, but with trillions of dollars.
The expert view here is that this is an orchestrated normalization experiment. They're trying to let rates rise just enough to kill inflation, but not enough to bankrupt the government. But the margin for error is razor thin. Is it a calculated, masterful move, or is it a trust moment? You remember the UK crisis?
The markets just completely revolted against unfunded spending and crashed the pound.
Right. There is a very real fear that strong Japan could trigger a similar revolt if investors decide the debt is just mathematically unsustainable. Takeichi is betting that the economic growth from AI and advanced chips will outpace the cost of the debt. She thinks she can grow her way out of the hole.
Which brings us perfectly to the actual mechanics of this. What exactly is she investing in that she thinks will save the economy? Because it's clearly not just bridges and roads anymore. It's survival tech. I was analyzing the strategic diversification efforts by Japan's government and corporations to secure critical mineral supply chains, particularly rare earths, amidst escalating China-Japan geopolitical tensions and their implications for global technology manufacturing and national security.
This is exactly where the abstract economics hits the very messy reality of geopolitics.
I saw a report online about a procurement manager named Akiko, who works for a medical imaging firm in Osaka. Her daily life has become a geopolitical battlefield. Imagine her frustration. Her company produces life-saving MRI machines, but the production line is currently stalled. Why? Because the price of yttrium, a rare earth element essential for the sensors, has hit a record high due to tightening export controls from China. Akiko spends her nights on video calls with suppliers in Perth and Denver trying to secure non-Chinese minerals. I heard that she keeps a map on her office wall with red pins on Beijing and blue pins on the new supply routes the Japanese government is subsidizing. She isn't a politician, but she feels the strategic mutual relationship between the two nations fraying every time she looks at a balance sheet. She's part of a silent army of Japanese corporate officers who are effectively de-risking the nation's technology future, one contract at a time, moving away from a neighbor they can no longer fully trust for survival. From my perspective, Akiko's struggle is a perfect microcosm of the new Cold War in tech. While it might sound like a right-leaning narrative of standing up to a rival, we have to see the practical necessity here. When a single nation holds the leash on critical resources, economic security is national security. I understand the frustration of those who miss the era of seamless trade, but in 2026, diversification isn't just a strategy, it's an insurance policy against the weaponization of the supply chain.
Akiko's map with those red and blue pins is honestly the perfect visualization of what the Ministry of Defense report is calling economic security. It's no longer just about soldiers and tanks, it's about sourcing managers and procurement logistics.
And the trigger for Akiko's headache, and really for this whole current crisis, was a diplomatic breakdown that started back in late 2025.
Right. It started with Prime Minister Takeichi's remarks on Taiwan defense cooperation in November of 2025. She essentially signaled that Japan would support Taiwan in conflict. Beijing, predictably, viewed this as a massive interference in their domestic affairs.
And they didn't just send a stern diplomatic letter this time. They went straight for the economic weapon.
They climbed the escalation ladder incredibly quickly. First, it was seafood import bans and travel advisories in November, just testing the waters. But then, in January 2026, the Ministry of Commerce in China dropped the real hammer. They announced a ban on the export of dual-use items to Japan.
Dual use is such a tricky, ambiguous term.
So, it technically means anything that could be used for military purposes. But in a modern economy, what isn't? A high-end microchip is dual use. A laser sensor in a self-driving car is dual use. Carbon fiber is dual use. And then came the administrative mechanisms causing massive delays on rare earths. It wasn't an official declared blockade, just endless paperwork.
Right, the classic death by bureaucracy. Suddenly, a shipment that takes 2 days takes 6 weeks.
Exactly. And for Japanese companies that practically invented just-in-time delivery, 6 weeks is an absolute eternity. It freezes the entire assembly line.
We really need to talk about these rare earth elements, or REEs. Why are they this specific choke point? I feel like we hear about them constantly, but why can't Akiko just buy them somewhere else?
They're essentially the vitamins of modern industry. You don't need a massive physical quantity of them, but if you don't have them, the whole organism dies. Japan relies on China for about 85% of its heavy rare earths and 90% of its processed magnets. But the devil is always in the details here. It's not just generic rare earths, it's specifically elements like dysprosium and terbium.
Dysprosium, what does that actually do in the real world?
Dysprosium acts like a heat shield for magnets. If you run a high-performance electric motor, like the one in a Tesla or a Toyota hybrid, it generates a ton of heat. Without dysprosium mixed into the alloy, the magnet literally loses its magnetism at high temperatures. Your car just stops working. The exact same physics applies to the tiny actuators in a missile guidance fin.
So without this one specific element, you cannot build a modern EV or a modern defense missile.
And you definitely cannot have a strong Japan military if you can't even build the guidance chip for your missiles just because Beijing decided to hold up a shipment of dysprosium at the port.
That is a severe vulnerability check if I've ever heard one.
Yeah.
The sources say Toyota and Honda have maybe 4 to 5 months of magnet inventory on hand. The defense industry is vulnerable within 3 to 6 months. That is not a long time if a real conflict kicks off.
It's the blink of an eye. And that profound vulnerability is exactly why the Japanese government rushed to pass the Economic Security Promotion Law. It's a fascinating piece of legislation because it basically allows the government to heavily intervene in private business for the sake of national security. It has 4 main pillars.
Let's run through them because this law really looks like the blueprint for the new Japan. Pillar 1.
Supply chain resilience. That is direct government intervention and a lot of state money to secure critical materials. Basically, the government is subsidizing Akiko's blue pins on the map. They pay the premium to buy from more expensive non-Chinese sources so the private companies don't go bankrupt doing the strategically right thing.
That's pillar 2.
Infrastructure protection. This was triggered partly by the severe cyber attack on the Nagoya port in 2023 that completely shut down Toyota's exports for a bit. It's about hardening the underlying systems that keep the lights on, the water flowing, and the trains running against foreign hackers.
Right. Pillar 3.
Public-private tech cooperation. This is the government pouring unprecedented amounts of money into R&D for critical sectors like artificial intelligence and quantum computing. It's essentially the state acting as a massive venture capital firm.
And pillar 4. This is the one that sounded straight out of a spy novel to me when I read it. Secret patents.
This is a massive cultural and legal shift. Historically, in Japan, the patent system was completely open. You invent something, you publish the details, you get legal protection. But now, if you invent a technology that has highly sensitive security applications, say a new type of uranium enrichment technique or a next-generation stealth coating, the government can force you to keep that patent completely secret.
So the patent office basically becomes a classified vault.
Yes, you don't lose your commercial rights, but the rest of the world doesn't get to see your blueprints. It prevents foreign rivals from just reading your public patent filings to reverse engineer your tech. It's a stark admission that information itself is a weapon now.
Alongside this new law, they are executing a strategy that's being called friendshoring. The logic being, if you can't buy it from China, buy it from a friend. This brings us to the Australian pivot. We have a press release here from Sojitz Corporation about a major deal with Lynas Rare Earths.
This is a strategically huge deal. Sojitz and Jojmek, that's the state-backed oil, gas, and metals corporation in Japan, invested 200 million Australian dollars into Lynas.
And Lynas operates the Mount Weld mine over in Western Australia, right?
But the key here isn't just the digging of the dirt, it's the processing. China's monopoly isn't actually on the raw minerals themselves. Rare earths are ironically quite common in the Earth's crust. The true monopoly is on the incredibly messy, toxic, complex chemical process of turning that dirt into usable metal oxides. China was simply the only country willing to tolerate the massive environmental cost for a long time.
So this Japanese investment directly helps Lynas expand its processing capability outside of China.
Yes. The stated goal is for Lynas to eventually supply 65% of Japan's total dysprosium and terbium needs. If they actually pull that off, they effectively break the Chinese stranglehold on the heavy rare earths market. It turns a geopolitical choke point into just a normal commodity market.
So that covers the raw materials end of things.
Yeah.
But what about the brains, the chips themselves? Because Japan used to be the absolute semiconductor king in the 80s. And then they basically lost it all to Taiwan and Korea.
Right. And getting that back is what they're calling the domestic tech renaissance. You have the JASM plant currently operating in Kumamoto, which is actually a subsidiary of TSMC, the Taiwanese giant. They are physically restoring advanced semiconductor manufacturing on Japanese soil. But Prime Minister Takaichi wants more than just manufacturing plants. She wants actual innovation ownership.
Enter the Rapidus project.
Exactly. Rapidus is the absolute moonshot. It's a government-backed consortium collaborating directly with IBM to build 2-nanometer chips.
2 nanometer is almost unfathomably small.
It is the absolute bleeding edge of physics right now. We're talking about the next generation of AI chips. Japan is trying to leapfrog from being just a specialized equipment and materials supplier back to being a premier manufacturer. They want to fundamentally own the future of compute.
It really is a complete structural overhaul. From 1980s protectionism, we went to 2000s hyper-globalization. And now we are fully entrenched in the 2020s era of strategic autonomy.
But that autonomy has a steep price. And it's not just paid in billions of yen or tons of rare earths. It's paid in human connection. When you start building walls, even economic ones, you end up blocking out a lot more than just magnets. Which really brings us to the final and maybe most visible layer of this pivot.
I was investigating the complex interplay between Japan's demographic challenges, its evolving geopolitical relationships with key neighbors like China, and the resilience and future direction of its inbound tourism sector, including shifts in visitor demographics and economic impact. Because when diplomatic relations freeze, people literally stop moving.
And nowhere is that profound freeze more visible than in the tourism sector right now.
Try to imagine walking through Ginza in January 2026 with a man named Kenji, who has sold luxury watches there for 15 years. He tells a story of a hollowed-out silence. In years past, the bakugai, or explosive buying from Chinese tour groups, was the heartbeat of his store. Now, following the travel warnings from Beijing and the shifting political tides, that demographic has plummeted by over 60%. I heard Kenji describe how he used to hire Mandarin speakers exclusively. Now, he's retraining his staff to greet visitors from Seoul and Sydney. While the total number of tourists is down, he's noticed something interesting. The Australian and Korean visitors are staying longer and exploring more local experiences. He watched a young couple from Brisbane spend hours talking to a local craftsman instead of just sweeping shelves clean. Japan's tourism sector is at a crossroads. The easy money of the massive Chinese tour groups is gone, replaced by a more fragmented, resilient, and perhaps culturally deeper flow of people. When I look at Kenji's situation, it's a stark reminder of how sensitive the economy is to diplomatic temperature. It's tempting to feel a sense of geopolitical rejection when seeing those tourism numbers drop so sharply. However, we should view this not as a permanent loss, but as a necessary evolution. Japan is learning to stand on its own feet, diversifying its customer base, just as it diversifies its mineral supply. It's a painful adjustment, but perhaps it leads to a more sustainable version of Japanese hospitality that isn't dependent on the whims of a single neighbor's travel policy.
The era of bakugai is officially over. That whole period where fleets of tour buses would pull up and tourists would just empty the shelves of high-end rice cookers and luxury watches, it's gone.
And the raw numbers confirm exactly what Kenji is seeing on the shop floor. Chinese visitor numbers plunged 60% in January 2026 alone. The estimated annual economic loss is projected at 2.2 trillion yen. That is 13 billion US dollars just evaporating from the retail and hospitality sector.
Just look at the stock market winners and losers to see the ripple effect. Isetan Mitsukoshi, the massive department store giant, down 11.4%, Tokyo Disney down 5.1%, JL, Muji all taking heavy hits. These are companies that basically built their entire decade-long growth models on the assumption of endless, frictionless Chinese demand. They are being severely punished for that assumption now.
It's not just about economics and exchange rates, though. There's a palpable chill in the air socially. The sources explicitly mention spy cases. That feels like something out of a different, much darker era.
It does feel retro, but it is the new, harsh reality. China has recently detained several Japanese nationals and businessmen on suspicion of espionage. And the real issue is that their definition of espionage has become incredibly broad under their new security laws. Taking a photo of a commercial harbor, doing standard geological surveys for a mining contract, or even just having a meeting with the wrong local official can get you detained.
That has to have an absolutely freezing effect on corporate business travel.
It has created a pervasive climate of fear. Japanese CEOs who used to fly to Beijing or Shanghai constantly to check on their manufacturing plants are halting their annual trips for the first time in 13 years. You simply can't do normal business if your executives are afraid of being arbitrarily arrested at the airport.
And it trickles down to the families living there too, doesn't it?
Japanese schools in China are facing unprecedented safety notices. When you get to the point where you have to tell corporate expats to be careful about sending their kids to school, the underlying social contract of the business relationship is fundamentally broken. A lot of those expats are just sending their families straight back to Tokyo.
So just like Akiko is being forced to diversify her rare earth supply chain, Kenji in Ginza is being forced to diversify his customer base. He can't just stand there waiting for the tour buses to come back.
Exactly. The industry calls it a pivot to quality. They are moving away from the high-volume model, just churning through thousands of budget tourists, to a high-value model. They are heavily targeting South Korea, Australia, and Western tourists who might buy fewer luxury goods, but they spend significantly more on experiences, high-end food, and local lodging.
I noticed in the Get Rent-A-Car blog post, which, by the way, provides some really interesting granular data, they pointed out a fascinating shift in behavior. They're seeing a massive surge in rentals for economy cars and eco-friendly scooters.
That makes total sense when you think about the demographic shift. The Bakugai tourist takes a chartered tour bus on a fixed route. The independent traveler from Sydney or Seoul rents a scooter or a small car and drives out to the countryside. They explore off the beaten path. It's a much more distributed form of tourism. It spreads the money out into the regional prefectures rather than just concentrating it all in Ginza department stores.
It definitely feels more economically resilient. If you depend on one single country for 60% of your revenue, you are incredibly vulnerable to their domestic policies. If you depend on 20 different countries for 5% each, you are insulated.
That is the exact definition of economic security. It trickles all the way down from the multi-billion-dollar semiconductor plant to the local watch shop. It's the exact same fundamental logic. Diversify or die.
So let's try to pull back and connect all these dots. We have Takaichi's high-risk macro fiscal policy spending money. The country arguably doesn't have to build a world-class military and tech sector. We have the industrial warfighting tooth and nail for rare earths and cheap independence. And we have the social decoupling, the certain end of mass tourism, and easy business travel from China.
The unifying theme across all three of those layers is the price of autonomy. For 30 years, Japan basically followed the path of least resistance. They relied on cheap manufactured goods from China, cheap and abundant tourists from China, and cheap defense provided entirely by the U.S. security umbrella. Now, they are finally trying to pay the actual bill to do it themselves.
And it is breathtakingly expensive.
It is incredibly expensive. They are essentially trying to reverse 30 years of structural deflation and 30 years of deep geopolitical integration at the exact same time.
Is it actually sustainable?
That is the trillion-yen question. Japan is really the canary in the coal mine for the rest of the developed world right now. Every Western nation in Europe and North America is talking about de-risking or decoupling in their think tanks. But Japan is actually doing it right now, in real time, on a massive scale.
If they pull it off.
If they pull it off, they become a fortress economy. A high-tech, highly self-sufficient power that can actually stand up to Beijing's economic coercion and simultaneously compete with Silicon Valley on innovation.
But if they fail, if the national debt finally explodes, or the domestic factories can't get the critical minerals they need, or the small businesses just collapse under the weight of these new interest rate hikes,
then strong Japan becomes a very dark, cautionary tale. It could easily lead to a sovereign fiscal crisis that drags down the entire global economy through that U.S. Treasury contagion we talked about earlier.
Exactly. Prime Minister Takeichi's vision is undeniably compelling on paper, but the real-world execution requires navigating a literal minefield. She needs the global bond markets to keep cheerfully buying her debt while she fundamentally restructures the domestic economy. She needs procurement managers like Eiko to secure those minerals in Australia before the existing factory inventory completely runs out. And she needs retailers like Kenji to find entirely new customers before his shop is forced to close.
It is a desperate race against time.
And a race against gravity. We have spent the last hour thoroughly examining how Japan is rapidly changing to protect itself from external shocks. But as I look at this map of new subsidized supply lines, and I look at the sheer scale of the new defense budget numbers, a final thought becomes very clear. As Japan builds its own leading-edge chip plants, secures its own critical mines in places like Australia, and heavily rearms its military, it is fundamentally changing the architectural balance of Asia. We so often look at these specific policies as purely defensive, just walls going up to protect the domestic market. But when a country that was once the world's quiet, pacifist, deflationary giant suddenly wakes up, starts spending massive amounts of capital, and actively starts securing its own global supply lines, it stops being just a passive buffer state. It becomes a major player. The reality is, once Japan truly becomes this strong Japan, the world is about to find out exactly what it intends to do with that strength.